Hello, welcome back to another video. In the previous video we have talked about the journal entries and we will continue this topic again with the further entries. So let us start today's lecture. So basically we have talked about these three entries. First of all, if we talk about ABC started business with cash 50,000 rupees. So there was a cash involved, basically 50,000. There was increase in cash because the owner was bringing cash within the business, so there was increase in cash. Whenever there is increase in cash, it means that there is increase in the asset and so on. So whenever there is increase in asset, it will always be debited. So here the cash account gets debited. And the second way, if we talk about the capital, the owner is bringing cash within the business and he will get repaid from the amount of profit. So capital lies within the equity account, so increase in capital will always be credited. If we talk about the second entry here, purchase goods of cash 20,000. So here the business made the purchases. So whenever we make purchases for resale purpose, we call it goods or the inventory. So good and inventory is asset. Whenever there is increase in asset, as we are going to purchase the goods, so increase in goods means that we have increased the asset. So whenever there is increase in asset, it will be debited. Here if we talk about what we paid to get that inventory is cash. So cash has fallen to an amount 20,000. So fall in cash means there is a fall in asset, so it will be credited. If we talk about the third entry, purchase stationery for the office use of the cost 2,000. Here we have spent the cost of 2,000, fall in the 2,000 rupees because we have paid that cash for buying stationery expense. So stationery is what we have purchased for the office use, that we buy registers on which we will carry out the transactions, or we buy pens through which we can write for the office use. So here is the expense of the office. So whenever there is increase in expense, it will always be debited. This was the previous lecture's transaction. Now we will continue with the further new transaction. Let us start today's video. Here it is the fourth transaction. Basically, first of all, we carry out sales on cash. Increase in cash means that it will be debited. So here we debit the cash. Basically there are two different type of entries. Basically the same entry is summarized in the two forms. Either we carry out both entries separately or we do it together. So whenever there is increase in cash, it will be debited. On the other hand, the sales account, which is a revenue account, it falls down, it increases, so it will be credited. And secondly, the debtor is about receivables. Whenever there is an increase in receivable, it will be debited. On the other hand, the sale will credited. Here what we did is basically the cash, this we placed, and then debtor, this one we placed, and these two transactions, basically 20,000, 20,000, here 40,000 we have added. So you can write the transaction or carry out the entry either on this way or this way. It is always your choice. Here we will talk about the next entry or the next transaction. Basically we have paid monthly rent of cash 2,000 rupees. So what is the monthly rent? That we live in a place and we have to pay the rent or the shelter of that place. So pay the monthly rent of cash 2,000 rupees. Here are cash involved, cash of 2,000 rupees, and rent is basically what? Rent is expense. So here is a rent expense involved. Now we will identify which account should be debited and which should be credited. If we talk about here, rent is an expense. Whenever there is an increase in expense, it will be debited. On the other hand, the cash is an asset, and whenever there is a fall in asset, basically cash is decreasing, that we are going to pay for that rent. So whenever decrease in cash, it will be credited. Here we will see how the entry will be written. Increase in expense, it will be debited, and decrease in asset, which is a cash, it is credited. If we talk about our sixth transaction, we have carried out purchases. Basically, we have purchased further inventory, but not on cash. We have purchased inventory on credit, means we will pay for that inventory in future. So here are our creditor whom we have to pay, creditor Ali. Basically, we will have to mention the name because sometimes there are more than one creditor, so each creditor will have different T account. We will discuss T account in the next video. And the second thing is inventory or goods. Inventory or goods. So now we have to look at which account gets debited and which should be credited. Here, goods are asset are increasing and it will be debited. On the other hand, there are the creditor Ali. So creditor is a liquidity account, a liability account, sorry. Liability means that we have to pay that person, so it is a liability. Whenever there is increase in liability, it will always be credited, because asset is equal to liabilities plus owner's equity. On this side, whenever this side increase, it will be credited. Whenever this side increase, it will be debited. Now we see how we will carry out this entry here. Goods are increasing, so they are debited here, and there is a increase in the liability, so it will be credited. If we move towards our seventh transaction, we take cash 3000 for personal use. What we do is that we carry out drawings. Drawing is an expense. Drawing for personal use, it is an expense. And on the other hand, we are reducing cash. These two accounts will be involved. Let's see which will be debited and which should be credited. Here, drawing for personal use is an expense, and expense is increasing. Whenever there is increase in expense, it will be debited. On the other hand, cash is an asset, and whenever there is a decrease in asset, it will be credited. So this gets debit and this gets credit. Here we see the transaction number 7, how it carried out. Here we will write drawing expense 3000. This gets debited to cash 3000. This gets debit and this gets credit. Now we will talk about its transaction, that we paid wages to our labor. So there is a word wages and there is a word salaries. The basic difference between the wages and the salaries is it is monthly based and it is daily based, or the weekly, mostly daily based, and it is monthly based. So there are two things involved, basically cash, we are paying cash is getting down, and wages expense. Now we will look here that wages is an expense is increasing and it will be debited. On the other hand, there is a cash is an asset and asset is decreasing. Whenever there is a decrease in asset, it will be credited. Now here we will see the transaction. Basically here this account gets debit, because whenever there is increase in expense, it will be debited. On the other hand, the cash is decreasing. So whenever there is a decrease in cash, there will be decrease in asset, and whenever there is a decrease in asset, it will always be credit. So in this video we have talked about 8 transactions that we have made. In the next video we will try to post them within the ledgers, and we will tell you how we can post these transactions within a ledger or the T account. Ledger and the T account are basically the same. The ledgers are basically in a well designed format, but the T accounts are simply like a T. So in the next video we will talk about T accounts. Hope you have liked my video. If you like my video, kindly subscribe to my channel and press the bell icon. Thanks for watching my video.